All right, so let's talk about assessing your risk tolerance before investing. Like, what the heck is risk tolerance? We're going to get into that in this video. This is John S. Rhodes of the Rhodes Brothers. Welcome to Greater Wealth Through Mastery. What a wonderful podcast this is for you. How can I assess my risk tolerance before investing? So, personal risk tolerance is crucial. Investors like you often seek methods to evaluate how much risk they can tolerate, how much they can handle in their investing and investment choices. So, what is risk tolerance? So, the very first thing, number one, first bullet point, reflect on your financial goals and, importantly, crucially, I might add, what is your time horizon? Because the longer you have, the more time you have, the more risk you can take on. Okay, let's dive into this. So, first of all, determine your investment goals, and that might be retirement, in the future, buying a home. It might be helping out a child with like a wedding, maybe their education, and it goes on and on. Maybe a second home, a retirement place. Maybe it's taking care of your parents, helping out your community. It can be a lot of different things. Everyone's different, but you need to know what your goals are. Critical. And then, as I mentioned, the time that you can leave your money invested before you pull it out or otherwise use it. And I'll say it again, the longer the time horizon, the better, because the longer the time horizon, the more risk you can take on, because you know that there's variation over time, of course. You know that the stock market goes up, it goes down. You know that there are recessions, and that has an impact on all kinds of investment. It could be real estate, it could be art, it could be venture investments, almost anything. Whereas time heals all wounds. Very, very critically important, of course. And I think you know this, but we're putting it on the table so you can go, that's what risk is. How much time do I have, and how long can I leave my investments alone? How long can I leave my assets to sit there and work for me? How can my money make more money over time? Critically important here. Okay, so that's bullet two. That's bullet one. Bullet two is evaluating your comfort with market fluctuations. Okay, so what I'm looking at here, just so you know, is that these are the exact same things that I've had very close, intimate conversations about with my friends and family, very close associates, and I'm sharing them with you right now. So I appreciate you, appreciate the time. Go ahead and hit that like button. It really does matter a lot. Okay, so bullet number two, evaluate your comfort with market fluctuations. Comes down to you need to consider how you'd react to losing a portion of your investment. So in other words, it goes down by 10 or 20% or more. Risk adverse individuals. So the more conservative you are, you may prefer safer assets like bonds. And in some cases, even cash, where you're earning some interest on that cash. Might not be a whole lot, but it's very safe for the most part. If you want to know more about having money in cash and inflation and having your money inflated away, which is its own risk, leave a comment below. That's critically important as well. But in any event, risk-adverse individuals may prefer what are considered safer assets like bonds or cash possibly, while risk-tolerant, in other words, you can handle the heat, you can handle the pain of the variation of the price fluctuations, you might choose or put more into stocks. Now, there's a lot going on here because some stocks are probably lower risk than some bonds. In fact, I would say something like a Standard & Poor S&P 500 index ETF might be lower risk than a very high yield junk bond portfolio or junk bond ETF where you're making like 7, 8, 10, 12, 15%. Whereas you might not make that amount of money with the S&P ETF. There's a lot less risk because that junk bond might look awesome and all the interest is coming in, right? The yield is very high, but then it crashes for whatever reason, right? Because it's a junk bond. If you want to know more about junk bonds, leave a comment below. I don't have time to go into it here for you, or you can look it up on your own in the future. But I'd love to talk about it. Just let me know. Okay, so that's bullet point 2. You have to evaluate your comfort, how you feel, right? Feelings are critical. In fact, behavioral psychology or behavioral economics or investment psychology is more important in many cases than the actual investments themselves. Now that seems counterintuitive, but it's not. The point is that if there's a lot of variation, it might freak you out. And when you get freaked out, you sell. And you shouldn't sell if things are freaking out. So you can let your assets freak out, but you can remain calm. If you can remain calm while your assets are freaking out, a lot of times you will make more and more money over time. Whereas, some of the safe investments won't do much, but you won't make much money. And you might have like 10, 20, 30 years, and that safe investment isn't safe because it's not even beating inflation. And it's certainly not going to beat the stock market in most cases. All right, this is not investment advice. This is what I would tell my friends and family and what I've gathered over the years, as well as talking with my brother, Matt Rhodes. Okay, so again, you're evaluating your comfort with market fluctuations, the ups and downs. You really need to know what kind of risk, the variance, the variability you're willing to take on, because prices do go up and down. They just do. That's the way it is. So again, risk tolerant investors might choose stocks, and they can, when the prices go up and down, they don't really worry about it. They don't bat an eyelash, so to speak. Okay. That's the second bullet point. The third bullet point is you can actually use risk assessment tools, right? Awesome stuff. Risk assessment tools. So that might be something as simple as going to a brokerage or a financial advisor. You can find these questionnaires online, and you can take the questionnaires to find out what your risk tolerance is. And there are always questions that are related to your time horizon, what you think that you would do under stress, or if you were frustrated. The questionnaires are really good that way because they get you thinking about what you would actually do. The problem with these questionnaires, just to be totally clear about it, the key problem, in fact, is that what you say is likely not exactly what you're going to do. And for some people, what they say really doesn't match up with what they're going to do. Some people are better at that, and other people are just terrible. They're just, things explode, and they can't take it. They say one thing, and then they explode. That can ruin an entire investment portfolio. It can ruin all the hard work that you did. The whole point is that what you think you're going to do might not be what you actually do. So that's why it's important to know ahead of time, to the best of your ability, what is it that you do? What is it that you feel? With your relationships, are you a hothead? Are you a cold fish? Right? Do things rattle you? Do you stay steady and calm? Are you ultra reliable as a friend? Do you drop everything and just go? Do you wait and calmly reflect? Do you just do things on impulse? So I bring all these things up, all the different ways that you act in your life in other ways. And very often, in my experience, it carries over to your investment tolerance and your investment risky, maybe risk level quite a bit. So if you're even keel, cool as a cucumber, then you're more likely to, steady as she goes. But you also might be more conservative and not put things into higher risk. Again, you've got to do the questionnaires. You've got to go to your broker. You've got to find these questionnaires and do that self-reflection and figure that out. It really, truly does matter. Okay, so the calculators online will help you gauge your risk tolerance based on your personality. I just can't stress that enough. And of course, your financial situation. Very, very important here. So how can I assess my risk tolerance before investing? Number one, reflect on your financial goals and time horizon. Evaluate your comfort with market fluctuations, and I would even say individual portfolio and asset allocations, right? What you've actually bought in the past. And when the price goes up and down, do you freak out? Or is it like, hey, no big deal, man. Easy sneezy. Okay. And then number 3, use tools that are available. Risk assessment tools are available. You can also ask friends and family. That can go a long way. Okay, so please give this a thumbs up, and more important than that, please subscribe to the Rhodes Brothers channel. We can't do these podcasts without your feedback. It matters so much. So leave a comment below, share it with a friend. And this is John S. Rhodes of the Rhodes Brothers, Greater Wealth Through Mastery. And we will see you in the next video. Thanks and take care.